This is Quent Bilo with an introductory discussion of job order costing. We'll explain the purposes of cost accounting, describe the flow of costs in a job order cost system, and discuss the importance of a job cost sheet as a subsidiary record to the ledger. While we'll focus on job order costing, we will contrast it briefly with process cost system, which will be the subject of the next chapter. So we're about accumulating costs in a cost system, spending for resources first, and then assigning that spending to production being made. It's important in this chapter to perform the journal entries as spending occurs and costs are assigned to production. First, what does cost accounting involve? The measuring, recording, and reporting of product costs. Costs that are fully integrated into the general ledger. Perpetual inventory systems provide immediate information on the cost of the product. Two basic types of cost systems, the job order cost system and a process cost system. The job order cost system, costs are assigned to each job or batch of jobs. The key item is that each has its own distinguishing characteristic. Our objective, compute the cost per job, measuring costs for each completed job rather than set time periods. Here's a graphic of a job order cost system. We see there are two separate jobs here, 9501, 9502, both printing jobs but different specifications. So each job having a distinguishing characteristic, costs will be calculated separately for each job. No jobs may ever be alike, therefore different costs. Contrasting this with the process cost system, we're talking about a large volume of mass-produced similar products. Costs are accumulated for a time period, such as a week or a month, and costs are initially assigned to departments or processes for a specified period of time. Here's an example of a process cost system. Similar products, mass-produced over a period of time. It's an homogeneous product, homogeneous cost. They'll all receive the same average cost for the time period involved. One more contrast, job order costing concentrates on collecting costs by the jobs, custom jobs, 101, 102, 103. Whereas process cost flow, the cost object is the department or the process, Department A, Department B. So in a job order cost flow, we're discussing unique costs to each job versus an average cost per period under process cost flow. Two different cost accounting systems. We'll concentrate on the job order cost flow in this talk. Review question. Cost accounting involves the measuring, recording, reporting of what? Product costs. Manufacturing product costs in the factory. The job order cost accounting parallels the physical flow of materials as they're converted into finished product. Manufacturing costs are first assigned to work in process inventory accounts as making the production begins. The cost of completed jobs is transferred out to finished goods inventory. That's the calculation of COGM we made in the last chapter. And when goods are sold, the cost is transferred to a cost of goods sold account, an expense account on the income statement. Here's a graphic of the job order cost flow. First, we spend for resources. The spending debits on the left are moved across the page as production advances toward finished goods with eventual sales. So it starts with spending, accumulating costs. Then it advances to progressing those costs across the page, work in process inventory as production begins, transferring it when it's completed, and transferring out on finished goods when it's sold. There are balance journal entries here, but the debit is the receiving object, whether accumulating costs on the left or assigning it on the right. Let's illustrate our first journal entry, a spending entry or a commitment to spend. Raw material costs. Wallace purchases 2,000 batteries at $5 per unit and 800 modules of another item at $40 per unit for a total of $42,000. The entry to record this purchase on January 4th is debit raw materials inventory, $42,000, increasing it. Crediting accounts payable, $42,000, increasing that. This is a commitment to spend. Had we credited cash, it would have been an actual spending entry, but the commitment is made. We're accumulating costs in the raw materials inventory account. Factory labor consists of three costs. A fully loaded cost, that is, gross earnings of the workers, plus employer payroll taxes and any fringe benefits incurred by the employer. Illustration of a journal entry. Wallace incurs $32,000 of factory labor costs. Of that amount, $27,000 relates to wages payable and $5,000 to payroll taxes payable. The entry to record the factory labor for the month is debit factory labor, $32,000, increasing that account. Credit factory wages payable, credit employee payroll taxes payable, increasing those two accounts with credits. The full cost of this labor is $32,000. This is an incurrence or spending entry, not assigning it. We're not yet assigning this to production. Manufacturing overhead example. There are many types of overhead costs: property taxes, depreciation, insurance, repairs, plant manager salary, supervisor salaries, etc. These all represent indirect costs of manufacturing, and they're accumulated in the manufacturing overhead generic category. Costs unrelated to manufacturing are expensed. These are period costs we talked about in our last talk. So manufacturing overhead is subsequently assigned to work in process in a later journal entry. Illustration. The summary data for manufacturing overhead for Wallace Manufacturing Company is $4,800 of utilities, $2,000 of prepaid insurance, repairs of $2,600, depreciation of $3,000, and property taxes payable of $1,400. We sum those entries up, debit manufacturing overhead, $13,800, increasing that account. That's an accumulation of cost. It'll later be assigned to work in process. Let's do it example. During the current month, Turner Company incurs the following manufacturing costs. Raw materials purchased are $4,200 on account. We incur factory labor of $18,000. Of that amount, $15,000 is wages payable, $3,000 relates to payroll taxes. Furthermore, factory utilities of $2,200 are payable, prepaid insurance of $1,800 is expired, and depreciation on the factory building is $3,500. Let's prepare the journal entries for each type of manufacturing cost element. Purchase raw materials on account. Debit raw materials inventory, $4,200, increasing it. Credit accounts payable, $4,200, increasing that account. The incurrence of factory labor, $18,000. 15 direct wages, $3,000 related to payroll taxes that the employer is responsible for. So the fully loaded cost is $18,000. We'll debit factory labor. This is an accumulation entry, $18,000, increasing that account. Credit factory wages payable, $15,000, increasing payables, and increasing payroll taxes payable by $3,000 with a credit. Again, both these entries are accumulation entries. They're spending entries. We have not yet assigned them to production. Moving to the overhead cost of factory utilities, insurance, and depreciation. The entries is debit manufacturing overhead, the total amount $7,500, accumulation entry. Credit utilities payable, $2,200, increasing that account. Bringing down prepaid insurance, $1,800 with a credit. And credit and accumulated depreciation, increasing that account, $3,500. Again, the total factory overhead costs for this period are $7,500, increasing manufacturing overhead account with a debit. Question: when incurred, factory labor costs are debited to what account? Factory labor. This is an accumulation entry. It is not an assignment entry. We will later assign those costs to work in process inventory in a separate journal entry when time tickets are analyzed for the jobs that are being performed during that time period. Let's move now to assigning manufacturing cost to work in process. Manufacturing costs are assigned to work in process as debits to that account, increasing it, and credits to either raw materials inventory that are used, factory labor that's been used to make the product, or applying manufacturing overhead. Those credits decrease those respective accounts. Now, a job cost worksheet is a separate record for each job. This is used to record the chargeable cost to a specific job to allow us to determine the total and unit cost of the completed job. The job cost sheet constitutes a subsidiary ledger for the inventory account. As work progresses, the job cost sheets mirror cost and work in process. Each entry to work in process inventory must be accompanied by a corresponding posting to one or more subsidiary job cost sheets. Here's an example. In this record, we'll accumulate costs by job number, all direct material costs that are incurred, all direct material costs that are used for the job, direct labor used in its assembly, and in manufacturing overhead applied. The bottom section will be completed later when the job is fully completed and moved to the finished product inventory account. First, this is a subsidiary record for the work in process inventory account as production begins. What's our basis for assigning raw material costs to work in process? It's the material requisition slip. This requisition slip is a written authorization to issue raw materials for a specific job. The material requisition slip may be issued directly for use on a job for materials specifically traceable to it, or there may be a requisition for indirect materials that are also taken out of raw materials account but cannot be charged directly to work in process. It's items not directly traceable to the product, such as lubrication grease for the machines. Here's an example of a completed materials requisition slip for direct materials. We know that because it's going to go into the work in process account. Job 101, 200 batteries, total cost of $1,000. These material requisition slips are to be controlled only as requested and approved, received by the production department, and later used by the accounting department to post this cost to the job cost sheet for job 101. Let's look at a journal entry now that starts assigning costs as production is started. This is moving the debit across the page to the work in process account. Wallace Company uses $24,000 of direct materials and $6,000 of indirect materials in January. So they've requisitioned two types of materials, both raw materials. The entry is debit work in process, $24,000 for the direct materials, increasing that inventory account. Debiting manufacturing overhead for $6,000, increasing that account. That's for the indirect materials. Indirect materials cannot be traced to a specific job, so it goes into an overhead account to be later applied to work in process. Crediting raw materials inventory, $30,000. We have one generic account here. In practice, there'll be several raw material accounts corresponding to different materials. A graphic of that entry. We've removed $30,000 from various raw material inventory accounts, moving $24,000 of direct raw materials into work in process, and the other $6,000 of indirect materials increases the manufacturing overhead account. In this example here, manufacturing overhead had a pre-existing balance of $13,008. We're increasing that by $6,000 in the current transaction. This is an example of progression of costs into work in process inventory and also manufacturing overhead. To illustrate what's going on in the ledger for direct materials and the corresponding job cost sheets, as work in process inventory is increased by $24,000 with the debit on January 31st, we see the total increases to job 101, $12,000, job 102, total of $7,000 for the month, job 103, total of $5,000 for the month. The job cost sheets may be posted as items of requisition for specific jobs, and at month end, the entry is made to the work in process inventory. It's important that the sum of all the direct material columns of the job cost worksheet should equal the direct materials debited to work in process inventory. See the note at the bottom. The job cost sheets may be posted daily. The general ledger may only be posted at month end. Again, the source of this was material requisition slips to specific jobs during the month. Factory labor costs, they are assigned to jobs on the basis of time tickets prepared when the work is performed. The time ticket would indicate who worked how many hours, what account or job was charged, and the total labor cost. Here's an example of a time ticket. Employee John Nash worked 4 hours on job 101 on January 6th, as approved by his supervisor, Bob Kadler, and later costed by the accounting department to bring that $40 cost into the job cost sheet of job 101. Source document for direct labor. Here's an example. Time tickets are sent to the payroll department, which applies the employee's hourly wage rate and computes the total cost. If $32,000 is the total factory labor cost, consisting of $28,000 of direct labor and $4,000 of indirect labor, the latter of which cannot be directly traced to a job, the journal entry is debit work in process inventory, $28,000, increasing that inventory account. Debit manufacturing overhead, $4,000, increasing that accumulated account. Credit factory labor, $32,000. In this entry here, we're moving money that was previously spent and charged to factory labor. Now we're moving those dollars into inventory and overhead respectively for direct and indirect costs. So we're clearing out the factory labor account and transferring those debits to work in process inventory and manufacturing overhead. Graphic illustration of that journal entry at the bottom. We've removed $32,000 from the factory labor account, which is an accumulation account, and we put $28,000 of that debit direct materials in work in process inventory, and the other $4,000 indirect labor into manufacturing overhead. We'll be accumulating manufacturing overhead debits and later applying a cost into work in process in a separate journal entry. Overhead costs cannot be directly traced in work in process. We'll look at predetermined formulas to enable that transfer of cost into work in process at month end. In the last journal entry, we dealt with $28,000 of direct labor costs charged into work in process inventory. At month end, if our total in work in process between direct materials of $24,000, direct labor of $28,000, total of $52,000, we see that in the various subsidiary records or job cost worksheets under the direct materials and direct labor columns. If we add up all direct materials for job 101, 102, and 103, 12,000, 7,000, and 5,000 respectively, and all direct labor assigned to job 101, 102, and 103, 15,000, 9,000, and 4,000 respectively, they should total the amount in the work in process inventory of $52,000. These need to be kept in sync. Review question. The source documents for assigning material and factory costs to job cost worksheets are material requisition slips and time tickets. That's for both direct materials and indirect materials, and direct labor and indirect labor. The analysis of all requisition slips and time tickets is the basis for assigning manufacturing costs to the correct jobs. If it's not direct materials or labor, those costs go to manufacturing overhead initially. Let's do an example. Danielle Company is working on 2 job orders simultaneously. The job cost sheets show the following. Direct materials to job 120, $6,000. Job 121, $3,600 for direct materials. Direct labor to job 120, $4,000. Job 121, $2,000. Manufacturing overhead, $5,000 to job 120 and $2,500 to job 121. Let's prepare the three summary entries to record the assignment of costs. This is a transfer of cost to work in process from the data on the job cost sheets. This is a summary journal entry at month end to pick up the direct materials for both jobs 120 and 121. We debit work in process inventory for $9,600, increasing that inventory, again for both jobs 120 and 121 direct materials, and credit raw materials inventory, $9,600, reducing that account for those direct materials used on the respective jobs. Direct labor entry. Debit work in process inventory, $6,000. Again, a composite entry for direct labor on both jobs. Credit factory labor, $6,000, reducing the factory labor account. That's an accumulation account. Costs have now been transferred into the work in process for direct labor. And finally, our manufacturing overhead journal entry. We will debit work in process inventory, $7,500. Credit manufacturing overhead, $7,500. We are applying overhead. We are moving it from the manufacturing overhead accumulated account into the work in process inventory account. We'll later see that this is done on the basis of a predetermined rate. We cannot directly trace overhead costs to individual jobs being made, but the predetermined rate has determined that we're going to assign $5,000 overhead cost to job 120 and assign $2,500 overhead cost to job 121. Not directly traceable. We'll see later we'll use a predetermined overhead rate to accomplish this. The debit increases the work in process inventory. The credit reduces manufacturing overhead account. To summarize, first, we spend on raw materials, incurring factory labor and overhead costs. As indirect materials are consumed out of raw material accounts, they're moved down into the manufacturing overhead account. They're accumulated down there. Likewise, for indirect labor that can't be directly traced to a job, we move down into manufacturing overhead. So all the cost accumulations, and then as we are converting our raw material into finished product, we'll move the debits across the page. We'll assign costs to work in process inventory. Our direct costs of material used will come directly from raw material account. Our direct labor that we can trace to the jobs will go into increasing work in process by debits, crediting factory labor. In manufacturing overhead that we cannot directly trace, we accumulated the indirect materials, the indirect labor, and other overhead that we've incurred, and we apply rates to get it into work in process job by job based on predetermined rates. Note that only inventory accounts can store usable values. That's why they have beginning and ending balances of assets in different stages of production. When goods are fully completed, we'll transfer them out of work in process, our COG inventory of the last chapter, and move the debit into the finished goods inventory, saleable goods. Here's a summary overview. You want to be able to trace the movement of cost across the page, what I call moving the cost object debit. From the initial spending for resources on the left, acquiring raw materials, paying for all labor, and for all incurred overhead costs, to then costing out the production being made to the work in process inventory account, transferring the cost of completed inventory into the finished goods inventory, and when sold, transferring the applicable cost to the cost of goods sold account. You need to become comfortable with the journal entries needed to affect such cost movements, and also the language used. Purchasing, spending, or incurring the manufacturing costs, assigning these costs to production, transferring completed goods to finished goods, and ultimately transferring product costs off the balance sheet and into the income statement expense account, cost of goods sold. A generic graphic of the dollars being moved across the page. Work in process inventory as production is made. The debits move to finished goods as they're completed and move to cost of goods sold as the goods are sold. The flow of costs in a job order cost system parallels the physical flow of materials in a job order costing system. Now, when a job is completed, the company will summarize the cost of completely finishing the job on the cost sheet. The lower portion of the job cost sheet will be totaled for all the direct materials traceable on the job, all direct labor traceable on the job, and manufacturing overhead allocated or applied to it. This job order cost sheet, when it's completed, then becomes a subsidiary record of the finished goods inventory account. So job cost sheets summarize both jobs completed and not completed. The cost sheets are subsidiary records of the work in process inventory account when production first begins, and becomes a subsidiary record for the finished goods inventory account when the job is fully completed. In a separate discussion, we'll talk about predetermined overhead rates and how that's calculated to apply those costs to jobs. Overhead costs that cannot be directly traced, but there must be a cost assignment on some basis.